Hi everyone, and welcome to this YouTube channel. My name is Penny, and this is Penny's Coding Bits. This channel is dedicated to bringing you weekly bite-sized videos with practical solutions to your everyday data analytical challenges. And this video is going to walk you through the US tax laws as they pertain to cryptocurrency trading. And this chatbot for US crypto tax is based on the structure that I had done for the New Year's resolution realization chatbot I had developed in December of last year. So the original idea was that I could type in my New Year's resolution in here. So I'll say, I want to be more fit and hit send, and the chatbot would give me weekly steps to achieve my goal. So this was the original idea, and for those of you who are interested in the code structure for this chatbot, you could click on the video up on the screen right now. But today we are going to walk through the US crypto tax, and this chatbot is designed to walk through various aspects for US tax on cryptocurrency trading. So, first of all, let's just walk through the overall income tax. So, I'll say, can you tell me about crypto income tax? And hit send, and it gives us some information. So if you've invested in lots of expensive equipment and you're getting crypto mining rewards as a result, your crypto is considered taxable income. So when you are reporting, you should report this income on Form 1099 NEC, and it should be reported at the fair market value of the cryptocurrency the day you received it. And this could mean if you mine cryptocurrencies when their price is lower, not only will you pay less tax, but you also enjoy the potential future upside as the value of your crypto asset goes up. So this is where it makes crypto borderline between money and asset. So the latter part of this is applying to all monetary assets, so stocks and options and all that, because you always enjoy the upside of this asset when you buy low. But crypto is money in itself. So when you receive it, you are considered getting paid, and that is subject to income. So when you enjoy this upside as the value of your crypto asset goes up, you also report this at the fair market value of when you received it on your tax return because it's monetary value that you received. Hope that makes sense. And crypto exchanges are required to report income of more than 600, but you're required to pay taxes on smaller amounts. And if you've set up a mining operation at home, you may be able to report your mining income as self-employment income on Schedule C, the same as if you are running your home-based business. So that's, in a nutshell, high level for income tax for crypto. So let's move on to capital gains. So I'll say, can you tell me about crypto capital gains tax? Okay. So it says, just like stocks and real estate, you must pay capital gains tax after you sell your crypto asset for a profit or a gain. And if you take a loss, you can lower your tax bill. And if you hold your crypto asset for over a year, so long term, you get the long term capital gains tax rate of 15 to 20%, rather than the short term capital gains rate of up to 37%, which is the same as the ordinary income tax. And you may still be subject to short term taxes if you use your cryptos to purchase things, whether it's tangible products or other cryptocurrencies. So, this is where it gets a little bit confusing between treating crypto as asset and money, because you can literally buy things with it without converting it into cash, essentially. So you can't do that with any other type of asset. You have to sell them first to buy things. But in crypto, you can buy things without converting them and selling them. So this is where IRS gets smart, because if you use your cryptos to directly purchase things, then they are treated as disposition of your crypto assets. Therefore, they are subject to capital gains tax. Makes sense? So what if you trade crypto as a corporation? Okay, so in the US, you can get a better tax rate if you create a business entity around your mining activities instead of mining as a self employed Schedule C individual. And if your overall net income is more than 60,000, filing as an S corporation or an LLC tax as an S corporation may help. And I'm just going into a little bit more detail of why that is. So, with an entity taxed as an S corporation, only the wages paid to its owners slash employees are earned income subject to FICA tax for Social Security and Medicare. And other net earnings passed through to the owners are considered dividend income, which are not subject to self employment contributions tax, provided the owner materially participates in the business and the payment are not considered passive. So essentially, you are paying your owner employee payments that are not subject to self employment contributions tax. So, in some cases, that could be a huge amount, and this could be a huge tax relief for when the entity is taxed as an S corporation. And additionally, the Tax Cuts and Jobs Act also gives pass-through entities such as the S corporation a 20% qualified business income deduction. So that is additional benefits for trading cryptocurrencies as an entity such as S corporation. And so what if you can't set up an entity to trade cryptocurrencies? Well, there is an option for you to trade as a day trader. So let's see about that. So if you qualify as a day trader, you may be able to claim your rewards as a self-employed individual. And in order to qualify, you must seek to profit from daily market movements in the price of securities and not from dividends, interest, or capital appreciation. And you must have substantial activity and carry on the activity with continuity and regularity. And this is an overall rule for qualifying as a day trader, whether you're trading crypto or any other kind of asset. So if you're trading crypto, then this rule will apply to you as well. And by qualifying, you can deduct all your trading related expenses on Schedule C, just like any other sole proprietor. So it's just like you're running your own crypto business at home and you're claiming it as a self employed business. So that is all for federal tax law. So what about state tax law? So Florida as we all know it, is considered a retirement haven as you don't pay individual income and death tax. And you also get a lot of asset protection and property tax benefits. And specific to crypto, Wyoming has great tax incentives for crypto companies and investors, as cryptocurrencies are exempted from property tax altogether. And this stems from their law that they had passed. So in 2018, Wyoming became the first state to define cryptocurrencies as an entirely new asset class. And Wyoming officials labeled it as the utility token bill and passed it into law in March 2018. It was designed to exempt specific cryptocurrencies from state money transmission laws. So there you go. It gives you some ideas of where is more advantageous to trade as a cryptocurrency trader. And what about forks? And this is kind of a unique topic as it pertains to cryptocurrency. So I just thought I would include it in here. So you can get free coins when a cryptocurrency is forked, where a portion of a crypto's community decides to create its own version of the currency. And when this happens, you must pay ordinary income tax on the new free coins instead of long-term capital gains tax on them. And this is because you're receiving money for free. And these money are considered your tax base that is being taxed. And so taxes will be calculated on the US dollar value of the new cryptocurrency the day you received it. So there you go. And last but not least, what about foreign cryptocurrency reporting? So if you trade foreign cryptocurrencies, what do you report on your tax returns? So let's see. So the Financial Crimes Enforcement Network, which stands for FinCEN, for those of us who are in tax who regularly report for foreign individuals, they issue regulatory guidance pertaining to reports of foreign bank and financial accounts, which stands for FBARs. So it's essentially a report that reports the individual's balance in their foreign bank accounts. And you'll be surprised to know that they are not requiring that virtual currency accounts be reported on an FBAR at this time. However, if the crypto assets are held in foreign accounts alongside other assets subject to reporting, it becomes part of the aggregate value that determines FBAR and FATCA reporting requirements. And so, tracking your short-term cryptocurrency trading activities becomes incredibly important because you need to track the maximum balance during the year and not just at year end. And with all of the fluctuations and tons of cryptocurrency types out there to trade, it becomes incredibly confusing to track your balance throughout the year. So consider these tools to use because they are proven and many people have written about them in books and journals. So they are very reliable to use. So the first one is Coin Tracker, and another one is Coin Tracking and Coin Ledger. So these are the latest information that I know that pertains to cryptocurrencies. And of course, they're constantly subject to change. So check back with IRS guidance when you are actually preparing your income tax returns or asset reporting reports. I'll see you in the next video.